And hello, South Florida. Hello to all the rest of the real estate world out there. My name is Eric Wilner, and I am the host of The Real Estate Show, which starts right now because it is now 5 p.m. And we know that we are here live at 5 days a week at five different ways coming at you from the AM direction, AM 1470, from the FM direction, FM 95.3 and 96.9. Those two stations I can remember. Then you can also listen to us on the free apps, the apps that also access the different radio stations like the iHeartRadio app, the TuneIn app, the radio.com app. All of them, search for WWNN Money Talk Radio 1470. And you can listen to us crystal clear and on the go on your smart device on any one of those free apps. You can also listen to us on our website. If all else fails, just always remember right here, therealestateshow.net. That's right, therealestateshow.net, or on our favorite website, theautomaticlandlord.com. That's www.automaticlandlord.com. Go to the top of the page where you can click on the Real Estate Show. It'll drop down. If you're there live at 5, then you can listen to us live. If you're there at any other time at your convenience, you can always listen to our rebroadcasts that are there available on demand. And you can even download the podcast version and take it with you offline wherever you go. So it's Tuesday, and Tuesday is our tools, tips, and techniques. As we've been talking this week, the topic has been equity. We spent the entire last week talking about credit. So it's sort of the flip side of the coin. And when you talk about equity, you're really talking about building equity, building wealth, whether it is for your own purposes. It's a great way to build a retirement source. It's a great way to build a legacy to leave and pass on to your heirs. But most of all, it can build a lot of security for you in the present. So equity is really the name of the game. At the end of the day, it's all about the equity. Now, having good credit certainly helps you get there better. We talked last week about how, what equity was or what credit was. We talked about the credit score, the number one most important number in your financial life these days. It really is. And how that can impact sort of the current that you have to swim against. Whenever you borrow money, the higher the interest rate, the harder and longer it takes to pay back, the more you pay back. Having good credit allows you to have a lower interest rate, and therefore it makes this whole idea of equity easier to build. And the pay down process, which we're going to talk more about on Thursday when we get into the money and how to build up equity faster. We're going to talk a little bit about some of these, what I call my ninja moves on building equity faster. So we talked about the components to a credit score, your payment history, the types of credit that you go on and take. So refer back to all our shows last week, all available at automaticlandlord.com. to get that really good foundation, because it's really part and parcel to what we're talking about. And there's a lot of other new and updated information on our website over there at automaticlandlord.com. So one of the things that we also were talking about is the whole concept of the first-time home buyer. And the reason I mention that right now is that we have our next workshop, which is scheduled for October the 12th. At 7:30 p.m. Now, the last 2 times we had standing room only on our Zoom workshop, we literally hit capacity. So it is important, if you want to come to this next one, to learn about the down payment programs that we have, the down payment assistance programs that we have, this special loans for first-time home buyers, which allow lower down payments. We have special programs for first responders and frontline workers that have lower interest rates, lower down payments. And we have even helped people get into a home, to own a home with hundreds of dollars instead of thousands of dollars. So it is a fact. It is a stone cold fact that we can actually own for cheaper than renting. Less money down, because you can't get around the first, last, and security, especially not these days where it's hard to even find a place to rent. Number 2 is that the payments, based on these low, historically record low interest rates, allow you to have a lower payment as well. So the bottom line here is that we are at an opportunity to own easier. And that's why, whether you're a first-time home buyer, whether you've never owned a home, or you just haven't owned a home for the last 3 years, that's the definition of a first-time home buyer for the lender's standards, is that you haven't been on title for 3 years. So maybe you got knocked out back in the big crash in 2008. No worries. We're now a long time after that. So by now, if you haven't had your credit cleaned up, then contact us, because we can actually show you how to put all of that mess behind you quite simply, as a matter of fact. So if you want to attend the workshop and learn everything about what we're talking about here for first-time home buyers, and I mentioned how this is important for investors. They should attend as well, because this is who their best target market is, are first-time home buyers, and it would pay dividends to know what this information is in your situation. So if you're interested in reserving your spot, text the letters DPA, that's down payment assistance, just the letters DPA, text it to 561-861-2366. That's 561-861-2366. DPA to that text line will give you the information. Now, that text line that we have there is also important for another reason, because every day at the end of the day, I write a report, a summary of what I just talked about on the air for today or that day. And that goes back out to those people who request it. And all you have to do to get a outline of what I covered in today's show is simply text the word equity, the word of the week. The word of the week, text the word equity to 561-861-2366. So we talked about the importance of raising your credit score, because it actually raises your equity in a property. When you have better credit and you're able to pay down things better, you're able to access more financing in order to leverage. Now, remember, we talked about in yesterday's show, we did some mathematical calculations, and I talked about how if you had $1 million cash, right, you're then considered a millionaire, right? You have $1 million cash. If you had $1 million cash and you put it in the bank today, the amount of money that you would make is $5,000 if you were able to get 0.5%, which is a lot right now for a savings account in a commercial bank now. So I doubt that you could live by simply putting your money in a bank account, earning interest from savings, or even a CD, because you're not going to do much better unless you tie it up for a long time. And I think that would be a mistake. As you know, certificate of depreciation, these things don't even keep up with inflation. And if you're anywhere but living under a rock, you know that right now we're dealing with inflation, which is much higher than what the banks are paying. And then I gave the mathematical example that if you were instead getting 5%, which you're certainly not going to get from any bank, in fact, you'll be hard pressed to get that and have any kind of liquidity anywhere. And if you put it in the stock market, well, that's a gamble. You put it in real estate, if you could easily get 5%. And in fact, most of the investors that I know wouldn't make a move for only 5%. But 5%, $1 million, would generate $50,000. A lot better than $5,000. By the way, these are annual returns. So 5,000 divided by 12 would be $400 a month. Social Security pays you better than that. It would be little more than a Social Security supplement. Can you imagine that $1 million is nothing more than a Social Security supplement? At 5%, it would be 5,000. So I'm sorry, 50,000. So now we're talking about $4,000 a month. And now we're starting to talk about a significant, or at least reasonable, amount of income to receive. Now let's start talking about more realistic. 8 to 10 to 12% returns would give you 80,000, 100,000, or 120,000, depending whether it's 8, 10, or 12%. It all depends on the investment that you do secure. But look at the difference from 5,000 at 0.5%, 5% gives you 50,000. 10% would give you 100,000. Divided by 12 is $8,300 a month. Now we're talking at least a more comfortable, certainly not luxurious, but certainly more comfortable at that point. And so how long would it take you to save up $1 million? And I had exactly this conversation today. And one of my colleagues in the real estate investment business said it took him 27 years to save up $1 million in cash. And he started looking at the way that he had earned that money, and he realized that was through a lot of sweat, hard work, and sacrifice. And and as I illustrated with the numbers, that isn't exactly a luxury retirement. That certainly wasn't the retirement he had been dreaming of. And he realized that he had to do something different, that simply being in real estate as a real estate agent wasn't going to solve his retirement problem. In fact, I will tell you this much, that unless you know what you're doing in the real estate business, the real estate industry has actually failed its agents in a massive way. When was the last time you went to a realtor's retirement party? I'll bet you've never even heard of one, because most real estate agents don't retire from real estate. They work until their 70s, their 80s, not because they love driving people around to go look at houses, but because they have to. There's an old joke, and I think it goes for a lot of the stockbrokers as well. But the reason they call them brokers is because they're broker than the people that they serve. But I can show you a better way. And that's why this whole concept of understanding what equity is. We talked about the definition. We even gave you the formula for it in yesterday's show, recording on our website at Automatic Landlord. But now you have to understand on how do you build the equity. And the neat thing about equity, which is, one of the key pieces of the real estate game. And now I'm talking not about being a realtor, but I'm talking about being a real estate investor. We look at it and we try to get our clients to focus on the 5-star approach to real estate. Now, the 5-star approach to real estate means that I'm looking for real estate that generates income. I'm looking for real estate that generates tax advantages so that I have tax advantaged income. I'm looking at real estate that creates equity for me. And I'm going to spend the rest of today's show talking about that particular star on our 5-star program. Then we look at real estate that is poised for appreciation. We believe that the best real estate is a real estate that you hold for the medium to long term. And so you want to be in an area, for example, Toledo, Ohio, not a place where you're going to get good appreciation. Florida, on the other hand, while it may be cyclical, it is a good recipe for, and one of our favorite markets for, appreciation. And then we look at real estate that allows you to get good positive leverage. And there's a big importance in understanding the difference between negative, neutral, and positive leverage. So that's what we're going to spend the rest of our show talking about on today's program. We're going to go ahead and take a quick break. Here are a few words from our sponsors. So don't touch that. Listening to the Real Estate Show. We're going to talk about equity, how you can get more of it, how you can accelerate it, how you can build it so that you can have more of it. Anyway, we'll be right back right after these words. Do I have any water? No, I don't. The Real Estate Show. For us to share with you. Hey, Annette. Susanna, thank you for typing that into the comments there. Text DPA and or equity to 561-861-2366. Right on. Thank you for that. I appreciate that. Susanna, one of our regular listeners, one of our loyal listeners. And I certainly appreciate that. I got Annette Salvatore. Sounds like a good Irish name, right? And then we got Christopher Hayes. We got, there's John. Erica. Right next to the studio. Oh, looks like we're getting ready to come back. What a hectic week already, huh? And welcome back. For those of you just joining us here on the Real Estate Show, my name is Eric Wilner. I am your host and your host here for the last 22 plus years, through good times and through the bad times. The Real Estate Show has been really a guiding light, a beacon, if you will, a lighthouse for the real estate world, for the folks that are interested, especially in accumulating more real estate. And one of the main reasons, part of, as I mentioned, our 5-star program, is equity. Now, equity is a really interesting thing, and worth a long conversation. In fact, it's what we're talking about for this entire week. And equity comes in a number of different vehicles. You can have equity, can be cash. Equity can be the difference between the market value of your property and any debts or encumbrances like loans against the property. That then is your equity. So if I own a property that's market value is $100,000 and I owe $80,000 on it, that means I have $20,000 worth of equity. Now, a lot of times, if you only put 10% down when I originally bought that 100,000, I could have created that additional equity, that 20%, because I was a good negotiator. Is that I bought the property right at a good opportunity where either I had a very motivated seller or I had a very favorable seller. Or just got a good deal, right? I was able to get it at a discount and thereby creating equity, which if the next day I turned around and sold the property, means that because of my negotiation, I literally created out of thin air equity, which I can then transform into cash value. And so that's one way that I can increase the equity. So, 3 people could go out to buy a house in the same identical subdivision. They buy the same house, the same model, which are all therefore the same market value. But one could go and pay list price. One might pay over the price because they wanted a certain lot location or a certain decoration that's in the house, whatever the case may be. And another person could pay a discount because maybe that's the offer that they made, and they gave a compelling reason, and the seller and the buyer had a compelling reason, because what is really the market value? It's what a ready, willing, and able buyer, what a ready, willing, and able seller are willing to come together on. Now, if on the same day, 3 people come up with 3 different sale numbers, of course, they're gonna factor that in, take an average, if you will, if they're identical, and that will be the market value. So that means that whoever paid list price, let's say one person paid 90, one person paid 100, and one person paid 110. We're going to come right back to that 100 number again. Now, another way that you can create equity, and this is the beautiful thing, appreciation in real estate comes when the market gives it, and the market giveth and the market may taketh. But the bottom line is that is something that you and I can't really affect. I can argue that one also, because we've gone into an area where we've improved a number of properties and created a new baseline market value in there, because we improved enough properties, and then we caused the comps to be higher. But other than that, the fact of the matter is, when real estate values go up, as they are going right now and at a pretty good clip, then the market value goes up. So if at the beginning of the year, for example, and we've had approximately a 7.5% appreciation just this year, that means if I had bought that same $100,000 house, good luck finding a $100,000 house in today's market, but I'm using this really as a concept, and multiply it by however expensive the properties are in your area, whether it's 200, 300, 400, just take this factor. But on a $100,000 house, if at the beginning of the year I paid market value, bought it for 100, at the end of the year my house is going to be worth 107,500, which means I created, or the market created in the appreciation, that $7,500 per $100,000 extra on top of it. And let's say if I put down $10,000 on that or 10% on that $100,000 house. Now at the end of the year, the house is worth 107. So I have my original $10,000 equity plus another $7,500. Even though real estate went up only 7.5%, my personal equity went up 75%, from 10,000 to 17,500, just short of doubling at 20,000. So that happened by appreciation. Now, negotiation could have gotten me some extra equity. I could, during that 1 year, upgrade the kitchen, modernize it. Maybe the kitchen needed updating, the bathrooms needed updating. I could have done any kind of upgrades in the house and increased the equity of the house, because then if I turned around and sold it, it would be worth more. So I can actually influence the growth of equity simply by A, negotiating, B, improving the property in terms of its current condition. A third way, I could add a bedroom. I could add a deck, a swimming pool. I could do other things where I add to the property. And for example, there's roughly, for every dollar that I spend in upgrading a kitchen, generally that has about a 2-to-1 return on what I do. And especially if you have friends in the business that you can get that work done for less. As most real estate investors, they get that work done at a very nominal cost. And therefore, that's why you see folks buying a house, buying it at a discount, fixing it up, further increasing the value of the property, sometimes increasing the size of the property, turning a carport into a garage, or turning a carport into an additional room. Very common thing that happens here in Florida. And now you've created equity where it didn't exist, or I created more equity than what I put into the property. And that's one of the beautiful things. So now you see where equity and understanding equity causes you to be more profitable in real estate. And if you do this with a focus on doing it, look at the difference of what happens. Because let's just take the average person who buys a house, lives in it as their own personal residence. And if they live there for long enough, 15, 20 years, if they live there 30 years and never refinance, now then another way that they built equity was through the systematic pay down of the mortgage. So that's the fourth way of influencing equity. In fact, even in a flat market, if the market isn't going anywhere, but I prepay the mortgage, or I learn how to accelerate the mortgage, and you know that we talk about that here on the air all the time, I can create equity again out of thin air, using the normal resources, the normal cash flow that I'm getting. And a lot of times in rental properties, it's the tenant's money that's paying down the mortgage. And if you know how to accelerate that mortgage, then you can even have your tenants help you to hurry up and pay down that house and give you more equity. Most people end up after 10, 20, 30 years with a house, maybe free and clear, and find out that they got all this equity that they never expected. Imagine if you did this on purpose and did it efficiently on purpose, how much more equity you could have had. If you want to learn more about that, text the word equity to 561-861-2366. That's 561-861-2366. Text the word equity, and I'll give you the breakdown on the 4 different ways that you can influence and increase your equity in your real estate, whether you own it, whether you rent it, but rent it out. If you're a renter, then you ought to attend our workshop on October the 12th and learn how to become an owner for less than the cost to rent. And you can do that by texting the letters DPA to the same number, 561-861-2366. That's it for today. This is Eric Wilner signing off. Be back here, same place, same time tomorrow. Until then, drive safe, wash those hands, and make it a great day. Bye-bye. Boom. Thank you all. Salvatore, Anthony, Susanna, again, thanks for posting that in the comments. Let me get that out of my ear. John Brown, the best handyman in town. And Paul, thank you. Talk to you all again, same place. Remember, give us a like here and share us down here below. Thanks.
If you've been a loyal listener to WWNN for some time, you remember Richard Pearl and his two radio shows, Pearls of Health and Richard Pearl on Politics. Sadly, Richard is no longer with us, but his vision of good health lives on with his family-run businesses, Simply Natural Restaurant and Simply Natural Nutrition in Sunrise. You can help his family by being a patron at the Simply Natural Restaurant. All healthy eating all the time. And Simply Natural Nutrition, the natural health alternative. Richard was on the search for all things good health, and it lives on. And we hope you support his family as they continue his tradition.
Oh, there we go.
Natural Restaurant and Simply Natural
Sometimes
Nutrition
I forget to turn this off.
University Drive and Sunset.